Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, March 14th. Another good week of volatility. Why do I say good? Volatility creates what? We speak to this all the time. Volatility creates opportunity. So things starting to get a little bit oversold. We had some good things happen and some bad things happen this week. Hard down day on Monday. If I had everything my own way, on Thursday that drawdown would have created a higher low versus Monday. Instead, it creased and came through Monday's low. Didn't spend a lot of time down there and bounced with a nice follow through today. So we have something to work against next week. We have two lows in a similar area. We'll keep an eye on that. How are our portfolios reacting? Bear with me. We're going to run through a handful of our portfolios. Let's start with US ETF. What did we do in US ETF this week? We added to the banks into some of that weakness. Banks have been a solid performer all year for us, have had a nasty drawdown, but to an area that has exhibited support previously. So we added to our banks in the form of KBWB, an ETF. Other than that, that took us down to about 6% cash in the account. A little bit of dry powder left. US Core, again, US Core, separate strategy. That's a balanced equity account between value and growth. Value held up relatively well again. Energy strong. Financials, as I said, hung in there. Utilities, decent bid. So, strength there, weakness in tech. So that's been an ongoing 3, 4, 5-week story. Weakness in tech. Have we found an area we can trade off of? Maybe some of the momentums in tech, the negative momentums have slowed down. That's the first step towards getting a reversal. Tactical trend. Interesting strategy, right? Multi-asset, not all stock. Stock, cash, some bond exposure. I don't know if we got lucky or we were just intelligent for once or twice, but our largest equity security has been for some time, Berkshire Hathaway, bam, new all-time highs. When that's your largest equity security, that does an awful lot to buoy the performance in the overall strategy. Where are we hurting a little bit in tactical trend? Microsoft, for one of the few times that I've owned Microsoft on and off and forever for 25 years. And it's a rare period over the last 5, 6, 7 years that Microsoft is having trouble exhibiting relative strength. Has me a little concerned, but again, it isn't an area that I would rather be a buyer than a seller. In that tactical account, we've been helped by our short-term treasury position. That short-term treasury position, paying 4 1/4, will be fuel, will be dry powder to take advantage of some of these prices at some point. So that's a quick wrap of more of our domestic holdings, domestic strategies. We'll take a look at international last week. From time to time when markets get tricky, I bring up the equity-only put-call ratio. It's been showing signs of complacency forever. In other words, people haven't been getting very panicky, even into this decline. We did see Thursday a 0.94 reading on the put-call ratio, equity only, in case you look it up on the CBOE yourself. Myself, over the years, especially in negative trending markets, I like to see us crack 1.0 or 1 on the equity put-call ratio, meaning there's at least one put being bought for every one call. If we can occasionally see a 105 or 110 spike, I close my eyes and buy. So 0.94, highest in quite some time. If we were to see something negative next week and we cracked 1, I'd get very aggressive on the buy side. Thanks for listening to my report. We have the moose on bonds. Stick with us. We'll see you next week.
Hi, I'm John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday morning on March 14th. This is the bond report. We're over here in beautiful Palm Beach. We're here for a bond conference. It's a gorgeous day. Will be a little bit of traffic later as the president's in town. This week in bonds, good news on the inflation front. CPI up 0.2, they're expecting 0.3. PPI, the producer price index, up 0. They were expecting 0.3. So that was good news on inflation. You didn't see it really reflected in the bond market at all, particularly not on treasuries, and even more not on municipal bonds. On treasuries, really, 10-year bond stayed right around a 4.30, 2-year bond right around a 4%. The noise that's out there, and we wrote a piece about this called The Certainty of Uncertainty. And the uncertainty that out there is the on again, off again tariffs. When will they be applied? Will they be applied? Will they be pulled back? Will they be inflationary? Throw in all the Doge cutting back on government. We know those people will be on the jobless claims fairly soon. So that kind of noise has kept yields probably from being lower than they would otherwise. Muni yields, on the other hand, were up this week. You look at the 10-year AAA muni curve, and that was up about 16 basis points this week to about a 312, 313. Why are muni yields rising this week? It's the noise level. It's the talk about, will they start to cut out tax exemption? We don't know this, but it's the noise level. And the noise level with uncertainty drives things only one way, and that is, take municipal bond yields higher. We're watching this. We think that muni yields are attractive. We think they'll probably even become a little more attractive as this noise goes on. And we're watching it. If you go back to past times when, Congress has taken this on, they have not removed tax exemption. It is in their ballpark to do so if they wish. But on the other hand, with a lot of potential federal monies and stuff and projects being put onto state and local governments, our thought process is it's hard to take away the ability of those municipalities, state and local governments, to finance at an advantageous rate, which municipal bonds allow them to do. We will be watching things next week, and talk to you then.